Hey everybody, welcome back to the channel. Cathie Wood just did a new interview and I really wanted to analyze this 3-minute segment of it. I did it on my morning live stream. I thought it was a very interesting segment. Basically, the question was, why do you think you're getting so much flack as a fund manager who is not doing risk management? We've heard this a lot, right? That Cathie Wood is not a good manager of money. She's just putting money wherever she wants. She's like betting on all these speculative companies, which means there's no risk management, there's no hedging, there's no ability for investors to feel safe with investing with ARK. She answers that in this interview. And then we also get a really interesting question that I've been looking for a while. So I'm very happy the interviewer asked her that question, which was this idea of compliance, right? We always look at companies. It's very difficult for them to do anything publicly, especially if they're public company CEOs or they manage a fund, because there's so many rules and regulations in regards to what you can say, what you can't say, as someone who manages public shareholder dollars. That's why you see YouTubers say like, this is not financial advice, all that stuff, because you're always trying to check yourself just in case the SEC comes and like says, hey, like you told this person blah, 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 and now you're getting sued. Like you always want to kind of have some reserve against it. So with fund managers and public CEOs, they're not allowed to say a lot of things. Now, Elon Musk is someone who goes against that, right, fully, because he just has no respect for the SEC. But freedom of speech when you're a fund manager kind of doesn't exist. And so what the interviewer asked her this question about, like, how are you able to get away with saying all this stuff? 50% CAGR, 40% CAGR. We're going to do this. We're going to do that. These stocks are going to go to the moon, deep value territory, because you have a lot of influence. The SEC has rules in terms of you exerting your influence on the public markets. How do you get away with saying all this stuff? So it was a very, very interesting conversation. And I think for people who are fans of Cathie Wood or at least interested in understanding her analysis, it is going to be important to sort of get the perspectives that she's giving out there when it comes to understanding more about how she operates her funds. So without further ado, let's get into the video. Let's start it off and then we'll discuss.
It is confusing sometimes to hear critics say, you know, there's no risk management. We have risk management throughout the firm. We have minority owners who are overseeing the risk in the firm. So we are looking at ARK as a slice of an equity allocation. And we have a study on our site, ARK-Invest, which shows that if you allocate, I think the study was 5 to 15% to ARK, take that from other equities, we will, over a 5-year period of time, increase your return per unit of risk. And that is why over the last 5 years, we have outperformed when most active managers have not. We have outperformed the NASDAQ and the S&P and the MSCI.
So the first thing she says, which is very interesting, is this idea that ARK is a slice of the larger growth equity markets. Right now, I would say it's a very big slice when you're betting lots of money on Zoom, Teladoc, Roku, Coinbase, Block, right? All of these companies that are speculative right now, that are likely, if all turns out to be correctly, going to grow and become massive, massive, massive companies. But right now, the market doesn't see it, which is fine. Cathie's saying, okay, if you don't see it in the short term, then you guys will see it in the long term, and eventually I'll be correct. So her argument around ARK and risk management is like, look, we have people that manage risk within the firm. We're not going to hedge and go long the S&P 500 and in case some of our stocks fall, so we have a hedge. That's not the type of portfolio or the type of fund that we are. The branding of the portfolio, the branding of the fund is this idea that if you want exposure to growth, you buy ARK. Now, you can buy a lot of other stuff. You don't have to go all in on ARK. But the reason ARK is all in on ARK is because they believe the companies they have chosen are going to be so monumental that every company in the world, every fund in the world, every index in the world, they're going to have some exposure to those companies because of how massive those companies are going to be. Essentially, Zoom, Teladoc, Roku, Coinbase, Block, DNA, these companies, Tesla, are going to be Microsoft, Amazon, Google, Facebook, etc. They're going to replace FANG and they're going to be better than FANG. That is the bet that Cathie is going for. And as a result of that bet, her argument is like, you should just have a slice of ARK as growth exposure, but you don't need to have all of ARK. And I mean, she has the results, right? She's been outperforming all of the indexes over the past 5 years. Now, Tesla is a big reason for that. Tesla is pretty much the only reason for that. But nonetheless, that is what the argument she's making.
So I agree with you that what I call tried and true, the core, many people treating ARK as a satellite. I think many people are, and as a hedge against the massive disruption that we see from innovation during the next 5 to 10 years. It's going to hit some of the stocks in traditional benchmarks.
It's amazing how much engagement you're able to get. I think you and your colleagues together have like 1.7 million Twitter followers. And then you've got on the other side of the coin this sort of legacy active where the PR people and the lawyers don't let them say anything. And if they do, it's very by the book and it doesn't really get anybody going. Nobody cares. I will say though, I think it's good. I think it helps your brand, but sometimes you'll say something and I'm like, why did she go that far? For example, the 40% return, sometimes you'll throw out a number. I'm like, why set the bar that high and maybe, upset your compliance person? Like, I think people are with you. Because don't you want to under promise and over deliver?
So this is going to be a really interesting part. The guy's like, look, why are you throwing out these crazy numbers? Like what? Like you just like, why do this, right? Why don't you say, I'm going to give you 20% and then give 50%? Isn't that way better? Like, and that's just in business in general, right? Under promise, over deliver. So Cathie's answer to this is actually really interesting.
So, well, in the beginning, we wanted people to just listen to our story, so maybe that's part legacy. But our chief compliance officer spent 4 years at the SEC as they were evolving guidelines for social media and marketing. And I started the firm saying, okay, after 0809, what did clients want? There was a loss of trust in the financial services industry, so transparency seemed to be very important. So that was, I invested much more in marketing at the very start of the firm than most would for this idea. In terms of the putting numbers out there, what we try and help people understand is the other side of what you said in terms of our return expectations based on growth, based on our research, is we're also, and people don't pick up on this as much, we're also saying these expectations are with an assumption that our multiples are going to compress dramatically. So I think many people are surprised to learn that Tesla's EV, so enterprise value to EBITDA, our expectation in 2026 is 14 times. It's below a FANG today. Now, do we think it's really going to be there if autonomous takes off? No, we don't. But where you do see aggressive assumptions, and this has to do with exponential growth revolving around Wright's law, Moore's law's relative, we have a high degree of confidence in the unit growth characteristics as these technologies go mass market. And we're really trying to communicate that. These technologies cutting across sectors are creating explosive opportunities.
All right, so that's the interesting part that I thought was the biggest part from this clip. So their argument for 2026 that Tesla's EV to EBITDA, so enterprise values to their EBITDA is 14, which is lower than some of the FANG multiples that we have today. Now, that sounds kind of crazy because you think Tesla is going to be like this crazy, amazing big company. I know it's already worth $1 trillion, but at least for ARK, you would assume their assumptions are super, super ambitious. So her argument is like, look, I'm not actually over promising because I'm saying that this is what we're going to get you, a 50% CAGR, even with the multiples of the EV to EBITDA being less than what FANG stocks have today. Now, so this proves her argument that it's really deep value, right? Because if she's like, look, 50% CAGR is still not over promising because of the valuations being below FANG multiples today, and obviously those valuations should be much higher if things go correctly, then that 50% CAGR might be even more, right? That 40% CAGR might be more. So her argument with throwing out these numbers is twofold. Number one, it gets people's attention. I mean, she's very obvious right there. She's like, we need people to listen to us. These technologies are disruptive. They're innovative. No other hedge fund, no other mutual fund has solely focused on disruptive innovation in the context of the public markets, and they truly was the first to do this back in 2015, 2016. So her argument is like, we needed people to listen to us, so we invested a lot in marketing and in branding to get people to give a crap about what we're saying. Second of all, she doesn't feel like the assumptions are overly ambitious given the valuation structures they've built in to actually be fairly conservative. And then if the true growth trajectories of these companies are correct, like the valuation structure, or like the autonomous part of Tesla, if robo-taxis take off, which they're really not factoring in, then those valuations are going to be insane. They're not going to be just 14. They might be, 30. And at that point, you got even higher prices, even higher returns if you invested in Tesla or ARK in 2022 by the time it goes to 2026. So it's going to be very interesting to see how this all plays out. But I thought this interview was a different side of Cathie that I've never seen before because she's talking about why marketing is important, why they needed to do marketing, why they needed to be branding, why they needed to be transparent, as they were talking about in 2008. Most people wanted transparency because they didn't trust the financial services. So ARK was like, let's just be as transparent as possible and tell them every trade we're doing. And on the flip side of that, it's phenomenal marketing, because not only are you keeping the SEC happy because you're literally telling what you're doing every single day. So like, how can the SEC complain? You're being as transparent as possible with people who are investing in your fund, which is more than the 45-day 13G forms that other people file. But on top of that, if you're buying 100,000 shares of Roku, well, you've got people at the tunes of millions looking at your trades. You got CNBC analyzing every move and telling people, hey, Cathie just bought 100,000 shares of Roku. Guess what? Roku's going to start to get some attention. So I think there's a really unique dual balance here. And because of that, ARK has been able to grow. Now it's a question of if they can actually execute and over-deliver on what they seem to be as an under-promise with this deep value territory that these stocks are in over the next 5-6 years. So will be very interesting. Let me know your thoughts on this interview from Cathie Wood. Thank you guys so much for watching. Looking forward to the comments. I will see you in the next one.